Most people who follow financial news have heard of stock markets, bond markets, and foreign exchange. Far fewer have heard of the repo market, which is larger than many of those combined and arguably more critical to the smooth operation of the modern financial system. The word repo is short for repurchase agreement, a transaction in which one party sells securities to another with a promise to buy them back the next day or a few days later at a slightly higher price. The difference between the sale and repurchase price is effectively interest. On paper, it looks like a secured loan. Party A needs cash overnight. Party B has cash and wants a safe place to park it, so Party B lends to Party A with treasury bonds or other high-quality collateral held as security. Trillions of dollars move through this market every day, most of it invisible to the public, turning over in cycles measured in hours. For decades, the repo market operated in the background, a piece of plumbing that financial professionals understood but that rarely made headlines. Banks used it to manage their short-term funding needs. Hedge funds used it to leverage positions. Money market funds parked cash there. Securities dealers relied on it to finance their inventories of bonds. The system worked because everyone trusted that cash would be available at a predictable price each morning, and that the collateral backing these transactions was solid. The assumption was that Treasury securities, the most common form of collateral, were as good as cash itself. That assumption held until September 2019, when it didn't. Most people who follow financial news have heard of stock markets, bond markets, and foreign exchange. Far fewer have heard of the repo market, which is larger than many of those combined and arguably more critical to the smooth operation of the modern financial system. The word repo is short for repurchase agreement, a transaction in which one party sells securities to another with a promise to buy them back the next day or a few days later at a slightly higher price. The difference between the sale and repurchase price is effectively interest. On paper, it looks like a secured loan. Party A needs cash overnight. Party B has cash and wants a safe place to park it. So Party B lends to Party A with treasury bonds or other high-quality collateral held as security. Trillions of dollars move through this market every day, most of it invisible to the public, turning over in cycles measured in hours. For decades, the repo market operated in the background, a piece of plumbing that financial professionals understood but that rarely made headlines. Banks used it to manage their short-term funding needs. Hedge funds used it to leverage positions. Money market funds parked cash there. Securities dealers relied on it to finance their inventories of bonds. The system worked because everyone trusted that cash would be available at a predictable price each morning, and that the collateral backing these transactions was solid. The assumption was that Treasury securities, the most common form of collateral, were as good as cash itself. That assumption held until September 2019, when it didn't. Part 1. On the morning of September 17, 2019, traders arriving at their desks in New York found something unusual in the overnight repo rate data. Rates that normally hovered just above the Federal Reserve's policy target had spiked. In some transactions, they reached 7%, more than triple the expected level. For a market that prided itself on stability and predictability, this was the equivalent of an earthquake. Banks that needed to borrow cash to settle their obligations faced suddenly exorbitant costs. Institutions that had planned their liquidity around smooth, cheap access to overnight funding discovered that access was neither smooth nor cheap. The spike lasted only a day in its most extreme form, but it revealed a fragility that had been building quietly for years. The immediate trigger was a confluence of technical factors. Large corporate tax payments drained reserves from the banking system. A wave of Treasury bond issuance absorbed additional liquidity. These events were predictable, part of the normal calendar, What was not normal was how little slack the system had to absorb them. In previous decades, banks held large cushions of excess reserves, which they could deploy in moments like this to smooth over temporary imbalances. After the financial crisis, regulations had changed. Banks were required to hold more capital and maintain more liquidity, but the composition of those holdings was tightly specified. The flexibility they once had to shift resources around on short notice had been constrained. As a result, when demand for overnight cash surged, there were not enough willing lenders to meet it at the usual price. The Federal Reserve responded within hours. It announced that it would conduct overnight repurchase operations, effectively stepping in as a lender to supply the cash the market could not generate on its own. The amounts were staggering by historical standards, tens of billions per day initially, then climbing to over 100 billion as the strain persisted. The operations were described as temporary, technical, and nothing to worry about. Officials emphasized that this was not a crisis, just an adjustment to accommodate new regulatory realities and seasonal liquidity patterns. Markets stabilized, rates came back down, but the need for Fed intervention did not go away. What had been framed as a one-time fix became a daily routine. To understand why this mattered, it helps to grasp what the repo market actually does. At its core, it connects entities with different needs and different balance sheets. A large bank might have excess cash at the end of the day and want to earn a return on it overnight. A broker-dealer might be holding an inventory of treasury bonds and need cash to fund other operations. The repo transaction allows the dealer to sell the bonds to the bank with an agreement to repurchase them the next morning at a slightly higher price. The bank gets a secured short-term investment. The dealer gets liquidity. The bonds act as collateral, reducing credit risk to nearly zero. Multiply this by thousands of transactions each day involving hundreds of institutions, and the result is a vast, decentralized mechanism for distributing cash and securities across the financial system. This mechanism is what allows the broader markets to function. Without it, dealers could not hold inventories of bonds, which would make bond markets less liquid. Banks could not easily adjust their reserve positions, which would make monetary policy transmission less effective. Money market funds, which provide cash management for corporations and institutional investors, rely on repo to generate safe, short-term returns. The system depends on the assumption that this market will always clear, that if you need cash and have good collateral, you will find a counterparty at a reasonable rate. When that assumption broke in September 2019, even for a day, it sent a signal that something in the architecture was not working as designed. The deeper problem was structural. For years, the Federal Reserve had been shrinking its balance sheet, reducing the quantity of reserves in the banking system. This was part of the normalization process after the extraordinary interventions of the financial crisis. As reserves declined, banks had less room to maneuver. At the same time, regulatory requirements meant that they had to hold more high-quality liquid assets and could not freely lend out excess reserves the way they once might have. The result was a system that looked safe on paper. Banks had strong capital ratios, ample liquidity coverage, but was brittle in practice. When an unexpected demand for cash arose, there was no buffer left to absorb it. The system had been optimized for stability in normal conditions, but it had lost resilience when conditions deviated even slightly from normal. The Fed's response to the 2019 repo spike was not a one-time operation, but the beginning of a new regime. After the initial emergency interventions, officials conducted reviews and decided that the system needed a permanent backstop. They introduced standing repo facilities, which allowed eligible institutions to borrow cash against Treasury collateral at any time at a rate slightly above the Fed's policy target. This was intended to act as a safety valve. If the overnight market ever seized up again, Participants could turn to the Fed rather than scrambling for private counterparties. In theory, just knowing the facility existed would prevent future spikes. In practice, it meant that the central bank had become a structural participant in a market that was supposed to be private. Alongside the standing facility, the Fed resumed expanding its balance sheet, though this time under a different label. Instead of calling it quantitative easing, which carried political baggage, officials described it as ensuring an ample supply of reserves. The goal was to keep enough liquidity in the system that banks would never again face the kind of sudden shortage that had triggered the September spike. The operational mechanism was simple. The Fed bought Treasury securities and mortgage-backed securities, crediting banks with reserves in return. Those reserves sat on bank balance sheets, available to be lent out in the repo market or used to meet regulatory requirements. The size of the Fed's balance sheet, which had been shrinking, began to grow again. This shift had profound implications. Before the crisis, the repo market had been a private ecosystem. Rates were set by supply and demand among banks, dealers, funds, and other institutions. The Fed influenced those rates indirectly through its control of the overall level of reserves and the interest it paid on them. After September 2019, the Fed was not just influencing the market, it was actively participating in it, providing billions of dollars in daily liquidity and standing ready to provide more if needed. This turned the repo market into something hybrid, still private in form, but dependent on public support in substance. Critics of this arrangement argued that it represented a form of moral hazard. If market participants knew that the Fed would always step in to provide liquidity when private funding dried up, they had less incentive to manage their own liquidity carefully. Banks could take on more leverage, dealers could hold larger inventories, and funds could operate with thinner buffers, all knowing that the central bank backstop was there. Defenders countered that the alternative, a fragile system prone to sudden freezes, was worse, and that regulations remained in place to constrain excessive risk-taking. But the debate revealed a tension at the heart of modern finance. The system had become so large and interconnected that letting any part of it fail risked cascading breakdowns. Yet, propping it up created incentives that made future failures more likely. The scale of the repo market itself is part of what makes it systemically important. Estimates of daily transaction volume range from $3 to $5 trillion, depending on how different categories of repo are measured. That is comparable to the entire annual budget of a major economy, turning over every single day. The vast majority of these transactions are routine and settled without incident, but the size means that even a small disruption, a 1% increase in the failure rate, or a few basis points of unexpected rate volatility, can translate into billions of dollars of unexpected cost or unavailable funding. Institutions that rely on this market do not have alternative sources of liquidity lined up. If repo stops working, their operations stop working. Another dimension of the problem is opacity. Much of the repo market is bilateral, conducted directly between two counterparties without going through a central clearinghouse. This makes it difficult for regulators and even for participants to see the full picture of who is lending to whom and on what terms. When the market seized in 2019, the Fed and other authorities had to rely on incomplete data and anecdotal reports to figure out what was happening. Since then, efforts have been made to increase transparency and encourage more transactions to go through central clearing, but progress has been slow. The decentralized, opaque nature of the market remains one of its defining characteristics. The Fed's ongoing intervention also raises questions about the boundary between monetary policy and market structure. Traditionally, central banks set the price of money, interest rates, and let markets allocate liquidity. In the modern repo regime, the Fed is not just setting rates, it is supplying liquidity directly in size on a daily basis. This blurs the line between being a lender of last resort, which is a core central bank function, and being a lender of first resort, which amounts to subsidizing the private financial system's funding costs. Proponents argue that in an era of complex interconnected markets and strict regulations, this kind of active management is necessary. Skeptics worry that it creates a system in which private profits are privatized, but liquidity risk is socialized. One way to think about the repo market is as the cardiovascular system of modern finance. Blood needs to circulate continuously, delivering oxygen and nutrients to every part of the body. If circulation stops, even for a few minutes, critical organs begin to fail. In the same way, cash needs to circulate continuously through the financial system, funding positions, settling trades, and meeting regulatory requirements. The repo market is the mechanism that moves that cash around. When it works, it is invisible. When it stutters, the entire system feels the shock. The fact that it now depends on a central bank standing ready to inject hundreds of billions of dollars at a moment's notice is a measure of both how essential it has become and how fragile the underlying structure is. The events of September 2019 did not produce a collapse, but they revealed that the system was running closer to the edge than almost anyone outside a small circle of insiders had realized. The subsequent interventions stabilized the market, but they also locked in a new normal, a supposedly private, decentralized funding mechanism that is, in fact, backstopped day in and day out by the full weight of the central bank's balance sheet. Whether that arrangement is sustainable over the long term and what risks it creates for the next crisis remain open questions that have not yet been answered because the system has not yet faced a true test since the backstop was put in place. What is clear is that the repo market, obscure as it is, now sits at the center of a much larger question about how much of modern finance rests on the assumption that the Federal Reserve will always be there to keep the cash flowing, no matter what. The dependency on Federal Reserve intervention also created a paradox for monetary policy itself. When the Fed wants to tighten financial conditions to fight inflation, it raises interest rates and withdraws liquidity from the system. But if withdrawing liquidity risks destabilizing the repo market, the Fed faces a constraint. It cannot tighten as much or as fast as inflation dynamics might warrant without risking a funding seizure that could cascade into broader disruption. This means that the very existence of the repo backstop may limit the Fed's flexibility in managing the business cycle, effectively soft capping how hawkish policy can become before market structure concerns override inflation concerns. The tail repo market stability ends up wagging the dog overall monetary stance. A related issue is the concentration of collateral. The repo market depends on high-quality securities, primarily U.S. Treasury bonds, to serve as the safe asset that borrowers pledge. But the supply of treasuries is not infinite, and as government debt has grown, an increasing share of that debt is held by the Federal Reserve itself through its balance sheet operations. This creates a circular dependency. The Fed buys treasuries to ensure ample reserves, which are needed to keep the repo market functioning, but buying treasuries reduces the supply available for private repo transactions. To compensate, the Fed lends treasuries back out to the market through securities lending programs. The result is a system in which the central bank is simultaneously the largest holder and a major lender of the very collateral that is supposed to make the private repo market safe and self-sustaining. The international dimension adds further complexity. The U.S. repo market is not isolated. It is connected to global funding markets through foreign banks, broker-dealers with cross-border operations, and dollar-denominated transactions executed outside American jurisdiction. When the domestic repo market experiences stress, it can transmit that stress abroad, tightening dollar funding conditions in Europe, Asia, and Latin America. Conversely, disruptions in foreign funding markets can feed back into the U.S. repo system. This interconnection means that the Fed's daily repo operations are not just supporting domestic institutions, they are also indirectly backstopping global dollars liquidity. That reality places the Fed in a position of providing a public good for the international financial system, a role it did not explicitly sign up for but cannot easily escape. Another unresolved tension is the treatment of non-bank financial institutions, particularly hedge funds and asset managers that rely heavily on repo funding for leverage. These entities are not subject to the same regulatory scrutiny as banks, yet they are deeply embedded in the repo market. When they face margin calls or redemptions, they can create sudden spikes in demand for cash that banks are unwilling or unable to meet without Fed support. This creates a subsidy dynamic. Non-banks enjoy access to cheap, liquid funding, much of it ultimately backed by the central bank, without bearing the full regulatory burden that comes with being part of the formal banking system. Proposals to extend tighter oversight to these actors have been debated, but implementation has been slow, leaving a structural asymmetry in place. Finally, the repo market's dependence on the Fed has implications for long-term fiscal dynamics. As the central bank's balance sheet grows to supply the reserves and liquidity the system requires, it holds an ever larger share of government debt. That debt pays interest to the Fed, which the Fed then remits back to the Treasury as profit minus its operating costs. In good times, this is a revenue generator for the government. But if interest rates rise and the Fed faces losses on its bond portfolio, those remittances shrink or turn negative, effectively transferring the cost of monetary policy back to taxpayers. The repo market backstop, by necessitating a large and growing Fed balance sheet, thus ties fiscal sustainability more tightly to the central bank's portfolio performance, blurring the boundary between monetary and fiscal policy in ways that could become politically contentious if losses materialize at scale.